Hey, this is Nick from Income Digs. Welcome to this video tutorial where we demonstrate the tools and systems that we use within our own real estate investing business. Today's video is a direct response to a question we received from Eric in the Syracuse, New York area related to the rental property investment analysis. So a couple specific questions. The first is surrounding how we deal with equity partners on a deal, on a investment. So I'm going to demonstrate that and show you how this works. And also a quick question about balloon payments and amortization. So to demonstrate that today, I have the rental property analysis template up, and you can of course download this for free on incomedigs.com. Look in the tools and resources section, and you can download this and follow along or use it for your own investments, however you like. It is free. So today I'm going to look at, try to keep everything really simple with a duplex, and I'm going to look at how we might finance this deal with a bit of bank financing, some of our own money, and then a little bit of an investment from a partner. So I have some data in here. It's just a duplex. It's a 2,400 square foot duplex. On the purchase details, I have a $200,000 purchase. I don't have any down payment info yet. I don't have any financing info yet or equity partner yet. That's what we'll fill in. I did go ahead and fill out the income and expenses for this property, and it's all arbitrary data. This is not a real property, but I'm assuming that we're getting $29.50 in monthly rent. I have kind of my standards in here: a 5% vacancy rate, $9.50 in annual insurance, some plowing services. I put in a 5% property management, 5% repairs and maintenance, property tax, some water as well. Now, the property management and repairs and maintenance, my tip is always to, when you're doing an analysis, whether you manage your properties yourself or not, whether you incur repairs and maintenance or not, it's a good practice to, when analyzing properties, put some numbers in here, because on the repair side, obviously you're going to have some repairs here and there. It might not be every month, but you'll probably have a few months of 0, 0, 0, and then you'll have a big repair, a hot water tank or something. So always have something in there. That's a good practice. And then the property management, even if you're doing it yourself, give yourself some credit for it there. One reason for doing this is because banks often would like to see that, especially on properties that are larger than 2 or 3 or 4 units. They're going to want to see some kind of number there for property management, because most buyers would have somebody else doing their management. There is a cost associated with that, so you don't want to get into a deal and say, you know, this is a good deal, I'm working really lean, there's 0 here. Assume that you have something. So I do. So you can see this deal is okay. It's an 8% cap at the $200,000 purchase. So let's go back up here and let's talk about how I'm going to finance this deal. So I need to come up with $200,000 cash. Now, let's say that I'm able to get a loan to my business for $150,000. So I'm going to go to the financing section. So $150,000 of 200, that's 75%. That's a pretty standard loan to value ratio. So $150,000. Let's say the interest rate is 5.5%, and I have the amort at 20 years, a balloon after 10. Now I have these kind of standard numbers in here. This is a typical commercial loan. So let's say that my business is getting loaned this money, and the house will be collateral for it. So that works out nicely. Now, if you're buying this personally, you might put a 30-year amort, a 30-year balloon in there. So it just depends on your situation. I'm going to have the 20 and 10 in there. So that's $150,000. Now I'm $50,000 short. So one way to do that is you could pay $50,000 out of pocket. Let's assume I don't have $50,000, or I don't want to put in $50,000. I only have $25,000. So I'm going to go up to my down payment here and put $25,000. All right, that is in there. Good. Okay, now I'm still $25,000 short, so this is where I'm going to say take on an equity partner. So I have this section down here, equity partner 1, equity partner 2. So let's call equity partner 1. He or she is going to give me that additional $25,000. Now what, oops, not 250, just 25. What will this person get in return for that equity contribution? It's not a loan. I'm not paying them principal and interest, The way that these are typically structured is this individual will get a percentage of the property's annual net operating income. Okay, so now it's important to note that this isn't always how it works, and these arrangements in equity partnerships can be very complicated and can be very different. The way that this is set up is for a very simple: I give you money and I get a percentage of net operating income. Some things will obviously be different, be more complicated. Maybe it's you're paying quarterly. Maybe you're paying. Maybe you're both taking on the loan, meaning that you would split the cash flow after the debt service. But let's assume a very standard equity partnership agreement here. So what would make sense potentially is this person's put up $25,000. That's 12.5% of the $200,000 purchase price. So it would probably be an okay number to put 12.5% as their equity stake. Okay, so they're giving me $25,000, and they're going to get 12.5% of the NOI on an annual basis. All right, so let's look at what that looks like from a cash flow perspective. If I click on my cash flow tab here, let's look at year one. And here we draw all of our revenues, our vacancy, and then all of our other expenses. And one thing is for sure, the water and sewer is way too high. I have to just go back. This is a $600 annually, not monthly. All right, that makes a lot more sense. Let's go back to our numbers here. So you can see that we're working down the income, the operating expenses. Here's the NOI, $22,740. That's the NOI for year one. Now, I personally, or my business, has a debt service obligation of $12,382, and that gets my cash flow before any equity partnership down to $10,358. All right. Now, the equity partner, I need to pay them a percentage of my NOI. And it's 12%, 12.5%. So right here we have a calculation that says take 12% of the NOI and put it here and take that out of my cash flow. And you see that goes down here. So my cash flow goes from $10,350 to $9,000 because I'm paying an equity partner for giving me some cash in the beginning. All right. Makes sense. So let's go back to the dashboard quickly here. One thing I want to point out, so we have the annual return for partner one at 5.2%, and basically this is just a calculation. They put in $25,000 and they're getting a return every year. Now, to be honest, 5.2% is pretty low, and you as the investor are getting a pretty good deal with this. It might make sense that this partner is looking for more than 12.5%. In fact, I would probably bet on it. I would bet that they'd be looking for 25%. This 10.4% return, which you saw it jump up to, that's a little bit more reasonable to expect on an investment like this. Your partner is going to want to get a little bit more. Now you can see that the deal is good enough that I'm still cash flowing positive. All of these cash flow figures are me personally. So everything's still okay with this property. So you can see that an equity partner is, in many cases, a good idea to come up with that extra cash that you don't necessarily have. Now, hopefully that helps with the equity partnership. Play around with it. You can have more than one equity partner. You can have two of them here. You could even potentially do a $200,000 purchase. Let's say I put up $100,000. The equity partner puts up $100,000, 50-50 split. Let's just quickly look at what that looks like. I just want to see the numbers. I want to do $100,000, and they have 50%. So that would work out okay too. So my cash flow is still good because I have no debt service, but that of course assumes that I can put down $100,000. Now you see my cash on cash return decreases because I'm putting in more of my upfront money. So you play with the numbers and see how the deal works best. To answer the second specific question from Eric is surrounding loans. And you saw me do it earlier, but I'm going to just revert this back to the 25,000 and the 25,000. Did it again. So if I had a loan of 150 let's pretend that I am purchasing this property personally. Now, most personal mortgages, as you guys are familiar, are either a 15 or a 30-year fixed for the most part. And they also typically don't have balloon payments. And the way to deal with it in this analysis is very, very easy. You just make the amortization and the balloon after the same. So if it was going to be a 30-year, I would say a 30-year amort and a 30-year balloon after. And that pretty much says, okay, your last payment is going to be the same as your other monthly payments. There's no quote-unquote balloon payment. It's the amortization is the same as the term. If I did 15 and 15, it'd be the same. All right. So very easy to deal with that. So whether it's a business loan that has a longer amort than the balloon, we can deal with that. Or if it's the more traditional, the same amort as the term, you can deal with that too. Just make those equal. Okay, so hopefully that answered Eric's question, but if anybody else has any follow-up or other questions about this, please post them in the comments or email me directly. These are my favorite videos to do because I like to answer your very specific questions. I like to deal with real-world investment problems and issues that you guys are having. So email me directly, nick@incomedigs.com, or post comments on YouTube. I will answer them, and I prefer to answer them with some kind of demo video. Until next time, I appreciate you watching. Check out all the free resources available at incomedigs.com, and I'll talk to you guys soon.